Hello, this is Eric Lynch, Director of Healthcare Services at Feeley Driscoll, CPA firm in Boston, Massachusetts. I'm here today to discuss healthcare finance and reporting. And if there are any questions after you listen to the podcast, we can be reached at 617-742-7788, or you can visit our website at www.fdcpa.com. I'm going to talk to you today in general about healthcare financial reporting and the differences between a healthcare financial statement and what healthcare entities do for financial reporting and what a normal for-profit entity would do for financial reporting. So I'll take you through. The first section would be an audited financial statement. The second section will be monthly financial reporting and the importance of the timely and accurate data and the benchmarks and dashboards that organizations use. The third section will be on the Federal Form 990, and for Massachusetts corporate, nonprofit, or healthcare corporations, the Massachusetts Form PC. And Section 4 will be other reporting, things like cost reports, OMB A133 governmental audits, and if you are a Commonwealth of Massachusetts corporation, the potential for a uniform financial report. First section, as I mentioned, is the annual audited financial statement. And again, I'm going to skew this to the differences between a healthcare entity's financial statements and a for-profit set of financial statements. So an annual audited financial statement for a healthcare entity needs to be performed in accordance with generally accepted accounting principles. And what that means is that there's certain set of statements that need to be presented in order to be in accordance with GAAP. The first is the balance sheet. Really no difference between a healthcare entity and a for-profit entity. A balance sheet is a snapshot in time of what the assets, liabilities, and net assets of the healthcare organization are. The second statement is a statement of operations or activities. And this is a little bit different, at least in name. A for-profit entity would call this the profit and loss statement. But the statement of operations or activities is where the organization reports its revenues, expenses, gains, and losses. The third statement is the statement of changes in net assets. The difference between a for-profit entity and a healthcare entity would be, on a for-profit entity, the statement of changes in members' equity. The fourth statement is the statement of cash flows. Again, not really a different statement from a healthcare entity to a for-profit, but as most financial people know, this is the most confusing financial statement that there is. It's where, as an auditor, I see the most mistakes made on a set of financial statements. But it's really, truly one of the most important statements that an organization can put together because it shows you where your cash goes on a yearly basis. It shows where the organization is spending its money, how it's financing its future, what the operations of the organization are either providing or taking from the organization. So while it's an extremely difficult financial statement to put together, it's one of the most crucial statements to understand your organization's activity. The notes to the financial statement are the next section. I won't go through all the notes to the financial statements, but I will pick out a few of the key healthcare-related footnotes that you'll see in a set of financial statements prepared for a healthcare entity as compared to a for-profit entity. And something I won't get into, but it bears mentioning, is that a healthcare entity can have consolidating or continuing schedules. And that could be a consolidating balance sheet or a consolidating statement of operations or activities, as well as other continuing or consolidating schedules that may be needed by a user of the financial statements. To get going, I'll start with the balance sheet, and I'll start with the current assets. Now, as I mentioned, the balance sheet is a snapshot in time. So if your healthcare entity has a 9/30 year end, so it's a fiscal year end, it's a snapshot as of 9/30. It's not an accumulation of activity up to 9/30. It is a snapshot of your assets, liabilities, and equity as of that point in time. So things that are unique to a healthcare financial statement. The first one's not going to sound that unique. Everyone's heard of accounts receivable. But what's unique about the healthcare industry is what goes into that accounts receivable. So that's cash that's expected to be collected within the next fiscal year, so within the next operating cycle. But that's made up of a couple of things. It's your gross accounts receivable from either your patients or the insurance company that your patients are insured through. Now, when we talk about accounts receivable, we talk about accounts receivable on a net basis, and that's net of valuation allowances. In a healthcare entity, there are two types of valuation allowances. The first is a contractual allowance. What a contractual allowance represents is the difference between what the service you provided to a patient costs and what that patient or its insurance company is going to pay you based on a contracted rate. So you could have a service provided that costs $100, so your gross accounts receivable would be $100, but based on your contracted rates, you're only going to get paid 75 cents on the dollar. Therefore, your net receivable would be $75. The second valuation allowance that goes into accounts receivable at a healthcare entity, like most other entities, is a bad debt allowance. To some extent, every organization knows they're not going to collect every dollar for service that they've provided. A healthcare entity already has netted out the contractual allowance that takes you from your gross receivable to your contracted rate, but on top of that, most organizations also put an allowance for bad debt for an amount that they historically have not collected on each of their accounts receivables. That typically comes about as a result of self-pay patients that do not have insurance, do not qualify for some level of free care, and as a result do not pay for the services that they are provided. Organizations typically have a methodology to estimate what that allowance for bad debts will be based on historical collection percentages, and they apply that on an annual basis to their accounts receivable to create that valuation allowance. Now, as an auditor, this is where I spend a lot of time looking at the accounts receivable and the estimates of the organization, because everyone knows an estimate is exactly that. It's an estimate. It's management's assumptions and conclusions about past, future, and present events that are allowing them to create these estimates. When management creates an estimate, we have a responsibility to make sure that that estimate is consistently applied, is based on facts, and is performed without bias for any particular reason. So this is where I spend most of my time in performing a financial statement audit, is with the estimates for accounts receivable as well as other estimates that management has significant judgment and influence on in the financial statement process. The second item I'll talk to you about is the current portion of assets whose use is limited, and in general, assets whose use is limited. This is really a unique consideration of a healthcare entity. And really what assets whose use is limited are, it's money that's being set aside, whether it's being set aside by the board of the organization or it's being set aside by a donor to the organization, but it's monies that cannot be used to support operations on a current basis. Typically, the current portion of the assets whose use is limited represents a bond fund, which is used to pay the outstanding debt of the organization on a yearly basis and is in line with the organization's debt documents and debt financing agreements with banks as well as potential municipalities. The board designated amount that is assets use is limited is an amount that the board has put aside from earnings of the organization on a year-by-year basis to be used to support the organization's endeavors, whether it be for operations, whether it be for capital expenditures, whatever the board has decided that amount will be designated for. The third type of assets use is limited that's usually seen and it's unique to the healthcare industry is donor restricted assets. And those are assets that are provided either through contributions or through a capital campaign that donors give and place specific restrictions on to be used only for those unique items. So for example, if a donor gives $100 to help build a new building, that's what the money needs to be used for. So it would be held in your assets as use is limited until it's used for that specific purpose. At that time, it can be used and spent to help build that capital building. Other things that are unique to the healthcare industry, other assets, that can be a conglomerate of information that goes into the other assets. What's typically seen in those on the audited financial statements would be other long-term assets like key man life insurance policies, non-qualified retirement plan assets, things like a 457 plan, and intangible assets. Now, it's always important to understand what's in the other assets because it's typically made up of more than one thing. And a good place to find that information would be in the footnotes to the financial statements that include include the accounting policies, which should spell out what's included in the balance of the other long-term assets. Moving on to the liability side of the balance sheet, there are a few items here as well that are very specific to the healthcare industry, and some other unique items that may not be seen on a routine basis in a for-profit entity. The first one has to do with another estimate, an estimate that is definitely unique to the healthcare industry, and that's your estimated settlements with your third-party payers. So as I mentioned, on the accounts receivable side, most patients have insurance, and those insurance companies do have contracts with the organization to pay specific amounts. Most famous insurance payer probably is the Medicare system through CMS. We have specific rates that organizations get paid by Medicare for each of the individual items of services provided to each of the patients. Well, the government is not foolproof, and they do make mistakes. And Medicare, the Medicare program, does overpay as well as underpay specific individual healthcare organizations on a daily basis. The issue that brings about is that the healthcare organization needs to estimate the amount that they're either overpaid or underpaid and include that as an estimate in the financial statements. That's the estimated settlements with third-party payers. Again, as an auditor, this is where I spend a lot of time reviewing my clients' assumptions, reviewing data from the individual insurance companies. I'll continue to use Medicare as an example. We look at cost reports that are filed with Medicare to see what activity and cost reimbursement is being applied to the organization. And then we look at what the organization does in terms of its actual calculations to come up with what their potential overpayment or underpayment is. And again, this is an area of high risk in a healthcare organization. It's an area where management has a lot of latitude to create an estimate, to create assumptions to be used. And one thing that we always go back to, again, is we take a look at the consistency of the application of the assumptions. We determine the facts and circumstances that are used to create those assumptions. And then we try to get as much third-party documentation as we can to validate those assumptions. But again, it's a very sensitive estimate on each healthcare organization's financial statements, and something that should be looked at closely by any reader of the financial statements to see what's happening in that third-party settlement bucket. If you're seeing large swings in that third-party settlement bucket, it should raise a red flag, or at least a question that should be asked of the organization. What's going on there? Why are you swinging from year to year so significantly? Again, assumptions and estimates should be consistently applied and be able to be backed up and supported by facts and circumstances. So it's important to understand how those estimates are created. Now, that estimate has both a current portion as well as a long-term portion. So the current portion, as you can imagine, is the amount that the organization believes it is either due or owes during the next operating cycle. And then the long-term portion would be the amount out into the future that it could potentially be due or owe to their third-party payers. So again, it's a unique item in the healthcare industry. It's one that causes a lot of confusion to many organizations, and it's an area that you really need to have a specialty and a focus to be able to understand and pull it apart to make sure that it's reported correctly. The next section is the next line item I want to talk about in terms of liabilities is an asset retirement obligation. And basically what that is it's a cost related to a future disposal of an asset. Now, this isn't necessarily specific to healthcare entities, but we do see it a lot in healthcare entities. Most healthcare organizations that have been, especially hospitals, are in old buildings. And when old buildings need to be taken down or they have significant repairs done to them, things get found. Things like asbestos, things like oil tanks that would need to be removed. Maybe there's been some oil spill. Those things all need to be removed by specialists. And it's incumbent upon the individual healthcare organization to identify those issues, whether it be asbestos that's in the building that will need to be removed in the future, whether there's an oil tank somewhere in the ground that will need to be removed in the future, and estimate the cost that it's going to take to remove those specific items at some point down the line. That cost needs to actually be put on the books currently and grown over time as a liability to the organization. It's basically a way for the organization to very consistently recognize an expense, sort of smooth the expense out over a number of years, have the liability on the books, and when the actual removal of, let's say, the asbestos occurs, to not take a one-time hit on the profit and loss statement or the statement of operations for that expense. So it's really a planning tool for a healthcare organization or any organization to be able to smooth out their expenses over a period of time rather than taking a big expense all in one period. The next line item would be a long-term pension and other post-retirement related liability. And this really has to do with the defined benefit plan. Most organizations do not have defined benefit plans unless you're dealing with large unions. At this point in time, there are still healthcare organizations that have defined benefit plans. So it's a unique element that needs to be vetted out through the process of the financial statements as well as the audit process. And typically what happens is there's an actuary, a specialist that is employed to come up with what the liability is going to be. So the actuary will take the information of the pension plan and come up with what the post-retirement related liability will be. So while this is sort of unique to the healthcare industry, it's also unique in that there's a specialist that needs to be hired to come up with what the liability is that gets reported on the financial statements. So it's something that we rely on, that our clients do. They employ these actuaries. The actuary provides a specialized report, and that report is used to accurately report the financial activity of the defined benefit plan. The next section on the balance sheet that I want to touch on was the net assets. And for anybody that's in the for-profit world, the net assets are really the net worth or the equity of the organization from an unrestricted standpoint. So there's three types of net assets. There's unrestricted net assets, which is truly the net worth of the organization. There's temporarily restricted net assets, and then permanently restricted net assets. Now, the latter two, temporarily and permanently restricted, are those items that have been given to the organization by donors that have put some type of restriction on, whether it's for time, whether it's for capital expenditures, whatever it may be. The restriction is either temporary or permanent, and that's how those are reported in the net asset section of the balance sheet. So when you think about net assets, think about net worth and the equity of the organization. Now, the temporary and permanently restricted net assets should tie back to the asset side of the balance sheet, that assets as use is limited, donor restricted. So we talked about that a few minutes ago. Those two should always be in sync. Your temporarily restricted and permanently restricted net assets, when combined, should equal your donor restricted, assets as use is limited. It's one of those great checks on the balance sheet that shows you how interrelated some of the numbers are. So as long as those things tie, you're starting off from a good place. Then you got to look a little bit deeper to make sure everything has been accounted for correctly. That brings us to the end of the balance sheet section of the specific healthcare issues. I'm going to start talking about the statement of operations now, which is the equivalent of the profit and loss statement, as I mentioned previously. So the first thing I want to talk about really is revenue recognition. In most healthcare organizations, the revenue recognition that takes place is through patient service revenue. And that patient service revenue is, like on the accounts receivable side, net of contractual allowances as well as bad debts. So patient service revenue is the revenue recognition basically comes down to what the payment on account factor is for each insurance contract that the organization has. So it's really the net revenue recognized for the period for services provided to your patients, less your contractual allowances and other adjustments to get to what your net revenue is. So your payment on account factor is what that contracted rate with each insurance company is. So using my example from earlier, if you have a service that costs or your charge is $100 and you have a contractual rate with an insurance provider for 75 cents on the dollar, your payment on account factor is 75%. On the flip side of that, that means that your contractual adjustment, which is one less your payment on account factor, is 25%. So again, it's another one of those items that is pretty unique to the healthcare industry, and it's something that creates a lot of work and a lot of review, a lot of analysis, not only by management, but by third parties looking at the financial statements like an auditor to determine whether or not the revenue recognition is in line with what it should be. Now, one thing that's happened over the past year or so is that there was a sort of a back to the future in terms of the provision for uncollectible accounts, which is the expense side of the allowance for doubtful accounts that we talked about on the accounts receivable on the balance sheet. The provision for uncollectible accounts for the past 25 years has been reported as an operating expense of the healthcare organization. Within the last year, the FASB released an accounting standards update that basically made it mandatory to report that provision for uncollectible accounts as a reduction of patient service revenue. And it's significant because what it means is that when you recognize revenue, you're only supposed to recognize revenue that you expect to collect. And as I mentioned on the accounts receivable side, organizations create this allowance for doubtful accounts, and on the flip side, the provision for uncollectible accounts, because they do not expect to receive a certain portion of the services that they provide because of individuals not being willing to pay their bills. So as a result, the Financial Accounting Standards Board issued the accounting standards update to say, really it shouldn't be an operating expense. If we're not expecting to collect it, it should be reported as a contra revenue account. That's a fairly new item in the healthcare arena in the last 12 to 18 months, but it's certainly something that was done 25 or 30 years ago, and it became industry standard to actually move it down to operating expenses. So as I said, it's sort of a back to the future type of situation that we're moving it out of operating expenses and back up to revenue. Now it's interesting because many of my clients actually never on their internal financial statements moved the provision for uncollectible accounts out of the revenue designation as a contra revenue account. This was really created by the CPA profession, the Financial Accounting Standards Board, and industry standards within CPA firms, moving that provision down to operating expenses. No surprise there that some of our clients were smarter than we were and left it in revenue because they never expected to collect it. So why would they recognize it as revenue? And they allowed there to be that difference between the internal financial statements and the audited financial statements, which I'm sure at the time when this was switched 20 or 25 years ago, created a lot of debate and discussion amongst management and the auditors. But management's won. It's now back up as a contra revenue account. And I think it provides a more clear picture of the actual revenue of the organization and gets us really back to that principle of revenue recognition as what you actually expect to collect. And if you don't expect to collect it, it shouldn't be reported as revenue. The next item on the statement of operations that is unique to the healthcare industry, and I'll cover two items in one here, is net assets released from restriction used in operations and net assets released from restriction used for the purchase of property, plant, and equipment. So we've talked a little bit about the assets used as limited, donor restricted on the asset side of things, as well as the temporarily and permanently restricted net assets in the equity net asset section of the balance sheet. So what the net assets released from restrictions used in operations or for the purchase of property, plant, and equipment is when those donor restricted amounts, when those restrictions are met, those amounts are actually released into the profit and loss statement, into the statement of operations. So if the donor gave money to be used in operations, once it was used in operations, it actually gets released from the statement of net assets and gets reported as net asset release from restriction used in operation as an other revenue line item. For the purchase of property, plant, and equipment, same concept, except that those amounts are reported as other changes in net assets, not as other revenue. So it's sort of in the third section of the profit and loss statement, the statement of operations, but nonetheless, it's if the donor is given money to support a purchase of property, plant, and equipment, once that restriction is met, that money can be released from the net assets and actually reported as a gain on the statement of operations. So two items that are definitely unique to the healthcare industry, the nonprofit industry, and bear mentioning in this arena. Moving down into the expense side of things, one item that is definitely healthcare specific is the uncompensated care assessment, or what now could be called, in Massachusetts at least, the health safety net care assessment. And what that basically is a tax to any Massachusetts hospital that participates in the health safety net. So basically, in order to participate in the health safety net, an organization needs to pay a tax, an assessment, to be part of the pool of funding that helps organizations that provide services to a disproportionate share of low-income families. So disproportionate share hospital is a hospital that's in an area that has a disproportionate amount of individuals that are either uninsured or that are insured through Medicaid, which, as most people know, is the payer of last resort. So those hospitals are actually helped out by the Commonwealth of Massachusetts, which has created this health safety net fund. It used to be called the uncompensated care pool. It's now called the health safety net fund. But in order to even participate in that, you actually pay a tax and assessment to participate, which is an operating expense of the organization. And then on the flip side, you receive funding from that health safety net pool as long as you fall into the category of a disproportionate share hospital, as previously defined. Now, one unique thing to a healthcare entity is that there are 3 operating indicators. So the first operating indicator is your income from operations. Your income from operations is exactly what it sounds like, what the operations have provided or taken from the organization in terms of income or loss. So it's your operating revenues less your operating expenses gets you to your income from operations. Now the next section, the second operating indicator, is the excess of revenue, support, and gains over expenses and losses, which is obviously a mouthful, but basically gets us into the second part of the statement of operations, which is your non-operating gains and losses. And that's really activities that are peripheral to the operations of the organization. So a healthcare entity is in operation to provide services to patients, provide medical services, provide lab services, provide therapy services to patients. They're not in operation to invest in the stock market or have contributions provided, go out and finding contributions. So those are things that are peripheral to the organization. And really this section, I basically call it the Wall Street section of the financial statements. Most healthcare entities do have a rather large investment portfolio, and a lot of that is done through that board designated fund. So the amounts that the board has set aside are then invested to create interest, dividends, realized gains and losses. They would create unrealized gains and losses. So those are really the Wall Street items of the profit and loss statement. But those are not considered operating items because the healthcare entity has not been put into organization to do those things. It's a peripheral transaction of the organization on a yearly basis. So other items that fall into that non-operating gains and loss would be, other than those Wall Street type items, would be contributions that the organization receives from the public, receives from other organizations. Those are not considered operating items either because the organizations, again, have not been put together to go out and get contributions. They've been put together to service the community that they're in. Those contributions are a secondary source of income, gain, loss for the organization. So once you factor in the non-operating gains and losses, you take it from your income from operations to your excess of revenue, support, and gains over expenses and losses. And this is what we see as being, in our client base, the sort of crucial operating indicator. This is what most organizations look at as being their true bottom line, how they're doing during the year. So they take into consideration not only the operations of the organization, but also those peripheral secondary activities of the organization, so the investments and the realized gains and losses and the contributions to come down to what they believe would be their total operations for the year. Now, the third section of the statement of operations for a healthcare entity would be your other changes in unrestricted net assets. So these are items that actually impact directly the net assets of the organization that aren't run through either operations or non-operating. And some of those items include, as we've already mentioned, the net asset released from restriction used for the acquisition of property and equipment, the pension liability, the adjustment to relieve or record the pension liability based on the actuary report is actually run through as a charge or relief of net assets in this section. It's really a non-cash item that gets run through the net assets as a specific adjustment. If there are any changes in accounting principles that have a cumulative effect on the organization, this is where they'd be put into place. So if the Financial Accounting Standards Board issued an accounting standards update that had retroactive application, this is where you would report the cumulative effect of that retroactive application of a change in accounting principle. We haven't seen one of those in a while. I think the last one was probably related to defined benefit plans, and that was a number of years ago. And after you factor in all of the other changes in net assets, you get down to your total increase or decrease in your unrestricted net assets. And this is really the total change from one year to another in your unrestricted net assets, factoring in both your operations, your not operating gains and losses, and then all of the other changes in your unrestricted net assets. That takes us to the end of the statement of operations and the unique considerations for a healthcare entity. I'm just going to spend a minute or so on the statement of changes in net assets for a healthcare entity. The first section of the statement of changes in net assets is the change in unrestricted net assets, which is really a duplication of the statement of operations once you get past that excess of revenues over expenses, gains and losses section. So it starts with that amount and then just factors in all those other changes in net assets to get us down to the true increase or decrease in net assets during the year. And that's reported on your statement of operations. So that's really just a regurgitation of the same information that is already presented on the statement of operations. The real activity that's presented in the statement of changes in net assets has to do with your temporarily restricted net assets. And this is where you report the activity for the temporarily restricted net assets. It's the contributions, any restricted grant revenue, realized gains and losses on your restricted investments, and then any net assets released for operations or for the acquisition of property and equipment. This is where you have the actual activity roll forward from one year to the next to support not only the beginning balance, then all the changes that happen during the year within that temporarily restricted fund to come to the ending balance that is reported on this balance sheet as well as a statement of changes in net assets. So this is it's typically a pretty simple statement to put together, but it does have a lot of impact because the amounts that are reported as the changes in the temporarily restricted net assets are also tied back to the statement of operations as well as the balance sheet and the cash flow statement. So it has a lot of implications for the rest of the financial statements, but it's definitely one of those statements that can be put together pretty easily. The next statement is the statement of cash flows. There's no secret here. This is not much different for a healthcare organization than for a regular organization, a for-profit organization. It's broken into three sections. The first section being your operating activities, the second section being your investing activities, and the third section being your financing activities. There's no real difference between a healthcare entity, but it does bear at least mentioning a few items here. I mentioned in the preface that this is the most difficult statement of all to create, to roll forward for organizations to get correct. And that's just because it really is an interrelation of all of the other statements, the balance sheet, the statement of operations, and the statement of net assets. But the one thing that you really need to be aware of in the statement of cash flows is the non-cash items. So non-cash items need to be backed out of the statement of cash flows to get back to what your true cash activity for the year was. So non-cash items for a healthcare entity include depreciation and amortization, that provision for uncollectible accounts, any other types of amortization or unrealized depreciation or depreciation on investments. Those are all amounts that no cash changes hand. So I'll use the example of purchasing a vehicle. Everyone says when you purchase a new vehicle, you drive it off the lot and it automatically depreciates by X percent. Well, that might be true, but you didn't lose any money. There was no cash that changed hands for that depreciation in value of your vehicle, right? It's a non-cash expense that personally impacts what you could potentially sell the car for. So until you sell the car, you don't actually recognize any gain or loss from that depreciation. So those amounts need to be backed out of your cash flow statement to get back to the true cash activity. So the first section, as I mentioned, is the operating activities. That goes through exactly what we've been talking about, the accounts receivable, any of your other assets and liabilities, and how they change from one year to the next. And it bears mentioning again that the accounts receivable, an increase in accounts receivable is actually a use of cash. So look at it as if your accounts receivable, which is money that's owed to you, continues to increase, it's like I'm giving somebody a loan. So I have a patient that comes in, they have a service performed, it costs $100. If they don't pay me that money, it's basically like I'm loaning them $100. That's actually a use of my cash. I'm not collecting the cash, so it has a negative cash impact on the statement of cash flows. On the flip side, in my accounts payable on the liability side, if I don't pay my vendors quickly enough, it's like they're giving me a loan. So that's an increase in my cash basis. So if I contract with the vendor, I buy $100 worth of services from them, and I don't pay them for 90 days, it's essentially like them giving me a 90-day loan that increases my cash value because I'm not paying down my expenses. So that's a tricky item that most novice cash flow preparers have a very hard time getting their heads around. So there's two items in the cash flow statement that are difficult. One is the non-cash items, because if you miss a non-cash item, you'll never have the cash flow statement correct. And then also the source and use. What is truly a source of cash and what is truly a use of cash? Because it's sort of counterintuitive to the logic of what the balance sheet says. The next section is the investing activities. And this is really cash that's used to invest in the company's plant or to put money away for the future. So this is where the organization reports its purchases of property, plant, and equipment on a yearly basis. And that's typically the biggest item in this. It's a use of cash. How much cash have you put out there to improve your property, plant, and equipment? But it's also an area that when the organization puts money away, so when the board designates money to be put away, this is where it's reported. So you're using up some of your operating cash to fund your future. So it's being taken out of operations and put into your investing activity. And then the third section of the cash flow statement is the financing activity. And it's exactly what it sounds like. It's how is the organization financing its future? Are they taking out debt? Have they received proceeds from the issuance of any type of debt? Have they paid principal payments back on any debt? Do they have capital leases that are being paid on a yearly basis? Is there a line of credit that's being drawn on? All that activity needs to be reported in here because that impacts the cash balance of the organization. But typically the financing activities are your principal payments on your long-term debt, and if you have taken out more debt, it would be the proceeds from that debt. So that basically takes us right down to the increase or decrease in cash and cash equivalents for the year, which then takes us to the cash balance at the end of the year. And the cash balance in the statement of cash flows needs to tie to the cash balance on the balance sheet. So again, showing the interrelation of the different statements within the financial statements. There's also additional disclosures on the cash flow statement. Cash paid for actual interest during the year needs to be disclosed separately. And the reason that the cash for interest needs to be disclosed is because the interest that's reported typically in the statement of operations has accrued interest in it that's not true cash. So this disclosure gets us back to what's the cash actually paid for interest during the year. And then an additional disclosure is any property and equipment that's acquired through capital lease obligations. So the FASB readers of the financial statements want to know what capital purchases are being financed rather than being purchased through the use of cash. It helps distinguish between the cash flow of the organization and what the debt leverage of the organization is. That takes us to the end of the actual financial statements. Now I am going to just touch on a few specific footnotes for a healthcare organization. And the first one that I'm going to talk about is the income tax. Now you might at first glance, if you're not familiar with the healthcare organization, understand why we'd be even talking about income taxes. And that's because they're nonprofit organizations and typically don't owe any tax. Well, the difference is that the IRS wants every organization to consider any of its tax positions on a yearly basis. So what's the most important tax position of a nonprofit healthcare organization? It's that it is a nonprofit healthcare organization. They have to be able to support that they are providing services in furtherance of its charitable mission to be able to continue to be a nonprofit organization that is exempt from taxes under the IRS code. Most healthcare organizations are organized as a 501c3 tax-exempt organization. And what this footnote does is it says, yes, we've taken into consideration our tax positions, quote unquote, being a nonprofit organization, and we don't feel like we're doing anything that would jeopardize that tax position, that we're providing the services that we should be providing. We're providing them at a level commensurate with tax-exempt status. And this is becoming more and more important as the IRS and the government continues to scrutinize the 990, the Form 990, which is the information return for a nonprofit healthcare entity. And I'll get into that in a couple of sections. It's a major issue in whether or not every healthcare organization is providing enough charitable care to the area that they're serving. And that sort of brings me to my next footnote that I want to talk about, and that's the charity care footnote. Or it could be known as free care, it could be known as uncompensated care. But this is the care that the organization provides, is exactly what it sounds like, for free. And this is where there's a major challenge at the IRS level and at the government level to whether these organizations should continue to be tax exempt if they're not providing a specific level of free or charity care to members of the community that they're servicing. And the Financial Accounting Standards Board actually changed the disclosures around charity or uncompensated care within the last year. And that change is really what is being reported as charity care and what the relevant measure of charity care is. Previously, most organizations reported charity care on a charge basis, what the charges were that they lost by providing free care. Well, as we discussed earlier, charges really don't mean that much because you have a specific charge. It's then reduced by your contractual adjustment, and then further reduced by the amount that you don't expect to collect as bad debt. So really the charity care charge is not a very good measure of the charity care that's being provided. Now what the FASB decided was that cost, the estimated cost to provide the charity care, that's the relevant measure. So what is the organization spending to provide every piece of charity care that they're putting out there? And so that means what's the salaries and wages? What are the supplies and expense? What's the overhead that's being allocated to charity care? The true cost that's being provided through the services that are not being reimbursed to the organization. So that was a change within the past couple of years, or past year basically. And this really gets down to the nitty-gritty of what's the right amount of charity care cost in relation to the whole organization. We've seen some percentages as low as 0.5% and some as high as 7 or 8%. But there's no indication by the IRS or by the government of what's the right amount, only that this amount is being scrutinized in general to determine if these organizations should continue getting their tax-exempt position. So again, it goes back to the organization looking at their tax-exempt purpose, making sure that they are providing that charity care and free care on a yearly basis, and then being able to quantify the cost of providing that actual charity care. Now, the quantification is not a very easy calculation. It's not something that is tracked very well by many organizations. And what the FASB has allowed is they've allowed for an organization to base the percentage cost of charity care based on a ratio of cost to charges. So it's a quick calculation. It's a relatively easy calculation to come up with the percent of charity care to the equivalent percentage of charity care patients to all patients served. So it's a ratio of cost to charges. It's an accepted methodology, but again, a very important footnote for the future of all tax-exempt healthcare organizations, and one that goes right along the lines of the community benefit reporting, community health needs assessments, and it's really an item of high scrutiny at this point in time. The next footnote I'll go through just very quickly is retirement plans and other post-retirement benefit plans. We discussed defined benefit plans on the balance sheet as well as the statement of operations. There's also a very detailed footnote that breaks down all the different components of an organization's post-retirement benefit plans and retirement plans. And basically it needs to be taken right through a description of each of the plans, what the benefit obligations of the plans are, what the changes in plan assets, what are the components of the net periodic benefit cost, both for the pension plan and the post-retirement benefit plans, if there are both. It's a very intrusive footnote, but it's a footnote that can be accomplished by using the actuary's specialist valuation report that I discussed earlier. So while there's a lot of information in this footnote, it can be really summed up pretty nicely using that specialist, the actuary that the organization would contract with to value their pension plans. The next footnote would be malpractice insurance coverage. Every healthcare organization has malpractice insurance coverage, and this is something that is pretty specific to the healthcare industry, but it's basically insurance coverage for the doctors or providers of the organization for the services that they're performing on patients or clients. And it's basically to cover the individual providers as well as the organization for any potential malpractice claims that may arise based on the services performed, whether it be a wrong-sided surgery or some type of complication that arises out of some of the services. There could potentially be lawsuits levied by patients of the organization against not only the provider but the organization. So it's important for a healthcare entity to have the appropriate malpractice coverage and also report that as an asset and a liability on the financial statements. So that's an item that is unique to the healthcare arena, and it's basically a protection for the organization in the event that there are lawsuits, which there are many lawsuits against every healthcare organization on a yearly basis, and this is one of the ways that these organizations can protect themselves. But it's an important footnote because it does bring the reader some comfort that the organization has gone through their risk assessment process and have the right coverages in place to protect the organization. The next footnote that we will discuss is the fair value of financial instruments. And this really is something that's been around for a few years now, and it was born out of Financial Accounting Standards 157, which was fair value reporting for a healthcare entity that really centers around their investment portfolio. And this is sort of unique to a healthcare entity. As I mentioned before, most healthcare entities have that board-designated assets to use as limited, which is typically a substantial amount of money. That money is then invested in the stock market, managed on a daily basis, and at the end of the day, we need to report the fair value of those investments in the footnotes to the financial statements. And the way that gets reported based on FAS 157 is they get reported based on what level of transparency each investment has to the user of the financial statement. So the organization needs to value their investments, typically done through the trustee that is managing the investments for them. And they're put into either a level 1, level 2, or level 3 investment category. Level 1 would be the most transparent level. That's an investment that you can go to the New York Stock Exchange. It has a quoted price in that active market, and you can actually get back to what the cost per share is and actually calculate the value at a specific point in time. Level 2 would be that you couldn't go necessarily to the New York Stock Exchange and find this particular investment, but there are other significant observable inputs, whether it be contracts or the such that the organization is able to use to value those investments. And then level 3 would be that there are significant unobservable inputs, that it's really a judgment call in terms of the valuation, and that there's really nothing to be able to go to and say, okay, we can anchor down this valuation based on some type of public knowledge. Level 3 is definitely the most difficult level from an audit perspective to get your arms around. You do need to do some type of valuation. This can be done through a specialist, or if you have the ability to do it in-house, it can be done. But all level 3 activity needs to be provided in a roll forward fashion. So you have your listing of your level 3 investments, and then that level 3 investment actually needs to be rolled forward from year to year so you can see all the activity within that account. So level 3 investments, things that we see in there would be joint ventures, private equity investments, alternative investments. Alternative investments are something that are becoming more and more prevalent as organizations start becoming more risk acceptable. Most organizations for the past 5 to 10 years, as we've gone through the ups and downs of the market and the economy, have been risk averse. Well, now that the economy has started to turn, more organizations are willing to accept more risk, and these alternative investments are definitely more risky, but with anything, risk provides the potential for a bigger reward. So organizations are definitely going through their risk analysis to see how much risk they're willing to take on and get into these alternative investments. And again, they do provide some unique considerations in terms of my work as an auditor, but certainly provide unique considerations for management in terms of how those investments are valued and how they're tracking them on a day-to-day basis. The last footnote that I'll touch on is the endowment footnote. So we've discussed a few times already the temporarily and permanently restricted net assets, as well as the donor restricted assets to use as limited. Well, this footnote kind of brings all that together and says, okay, what endowments does the organization have, not only from a board designated perspective, but also from a temporarily restricted perspective, as well as a permanently restricted perspective. Now, your permanent restricted investments are your true endowments. It's the amounts that have been provided to the organization that can never be spent, that can only basically accrue interest, dividends, and investment income, which can then be used to either support operations or to support a specific purpose based on the donor's intent. So those are true endowments of the organization. Your temporarily restricted endowments, or what are called quasi-endowments, are basically the appreciation of your permanently restricted funds that have been transferred to temporarily restricted and are awaiting appropriation by the governing board. So the board of directors has the ability to appropriate a certain amount of that temporarily restricted appreciation on a yearly basis to support the organization. And the way that is done is transacted through what's called a MIFA, which is the Uniform Prudent Management of Institutional Funds Acts, which basically provides the guidelines for organizations, governing bodies to follow when they are releasing that appreciation. The Commonwealth of Massachusetts actually has its own separate rules as well, that you can only spend up to 7% of the endowment fund balance appreciation on a yearly basis, and MIFA sort of follows that same rule. They say that a prudent amount of spending on a yearly basis would not be over 7%. So then the last piece of this footnote is the board designated endowment, and again, that's the amount that the board has set aside on a yearly basis to support the organization into the future. So that brings us to the end of the footnotes and just a couple of just administrative items. So I mentioned a few of the updates that have happened in the past couple of years as I was going through. I'll just give you the actual accounting standards update. So the first one is accounting standards update number 2010-23, which is measuring charity care for disclosure. That was the determination that cost was the relevant measure of charity care, and that's what should be disclosed in the financial statements, which we discussed in the charity care footnote section. Then there's Accounting Standards Update 2010-24, which is the presentation of insurance claims and related recoveries. That it really has to do with malpractice insurance and malpractice coverage in reporting both the asset as well as the liability on the balance sheet. And then Accounting Standards Update number 2011-7, which is the presentation and disclosure of patient service revenue, the provision for bad debts, and the allowance for doubtful accounts for certain healthcare entities. And that goes right back to the thing that we really led in on this was the revenue recognition and moving that provision for uncollectible accounts from operating expenses up to revenue as a contra revenue item to make sure that the organization is only recognizing revenue on amounts that they expect to collect in a given year. The next section is internal financial reporting and monthly financial reporting that an organization does on a monthly basis. So certainly I've talked about a set of audited financial statements, but the organization on a monthly time frame has to create monthly financial reports for the governing body to make decisions, to look at trends, and so it's a truly crucial part of the healthcare organization is having a strong financial management function that's able to provide the right information to the right people in the right timing for decisions to be made. So things that we see commonly would be, as we just sort of discussed, we see balance sheets, statements of operations. And those statements of operations are usually set up as an actual versus budget presentation. Key financial and operating indicators are what's more commonly known as a dashboard. There's also a lot of statistics that get reported, whether it be by department, by service line. I know those really reflect the levels of activity each one of those specific items are providing on a monthly basis. And then there's typically additional reporting that's the entities decide is important for their specific organization. Now, the one thing that we really like to see, and most organizations that I deal with like to see, is trends. So they don't want to just see 1 month. They want to see multiple months, and they probably want to see multiple years, and they probably want to see a comparison that shows them the trends and the peaks and valleys. Because the more information you have, the easier it is to see when there's issues, whether there's peaks, whether there's valleys, whether there's a smoothing or a constant impact of a certain transaction. That's the type of information that decision makers need in order to make informed decisions and educated guesses. But really, when you talk about the monthly reporting, it needs to involve both management and the governing body. So the management needs to understand what the governing body needs, and the governing body needs to understand what management's capabilities are. So they can't just go asking for everything. They need to be able to boil it down to what's truly important and what's going to help the organization make the right decisions. So some of the best practices that we see in terms of the monthly financial reporting, very simply, is to incorporate charts and graphs to display certain financial ratios, trends, operating results, and financial position. So it's really giving some non-financial information in a very easy to see format. Management can put a lot of information, a lot of numbers on a piece of paper, but it may not mean a lot to somebody that might not be financial in nature. So your governing body could have, say, a professor or someone from the community on it that's not in tune with the actual financial statements and the numbers on it on a daily basis. But to be able to see it in a chart or graph, you can really easily depict where there might be issues, where there's a big dip in some type of analysis or activity, and where there's maybe a good trend in another that you can really dig into and understand what's going on with the organization. So charts and graphs definitely help sort of display the activity that you're trying to get across. Issuing financial statements in a timely manner. So what we like to see as best practice is to have them issued within 20 working days of the period end. And the reason this is so important is that the organization needs timely and accurate information to make decisions on a real-time basis. If the financial reporting is delayed on a monthly basis, then the decision-making process is delayed. Or even worse, the decision-making process is being made without good information, or with missing information, or with invalid information. And that's something that the organization definitely wants to avoid. Now, you never want to make a decision in the blinds, and one way to make sure that you at least can get towards an educated decision is to have that timely and accurate financial information in front of the governing body. The financial statements, again, the next item would be that they should be self-explanatory, and there should be verbal comments that educate the users to specific issues and concerns that are popping up on a monthly basis or on a trend basis. And there should be specific action plans that management is already considering, is already put into place to fix issues, or hopefully for the good, to continue positive trends. So that it should be a self-explanatory process, and really it should be used as a basis for education for the governing body. And the last one is that management shouldn't overload the governing body with too much information. It should really be brought down to the key items that they need to see on a monthly basis, that they want to see on a monthly basis, that they consider to be high risk, high publicity issues, the issues that are going to help them help the organization. So management's going to have a lot of information behind the scenes, but should only present an abridged version of that information to the governing body. And if needed, have that information available for the governing body to get its hands on if anything pops up in their review of the financial statements. Another item that we consider to be a best practice is getting beyond just the financial information, but it's looking at ratios, it's looking at key indicators, leading indicators, and it really goes back to that dashboard concept of what's truly important to the organization, what trends, what activities, what ratios are driving the organization. So is it operating days in cash, total days in cash, days in accounts receivable, days in accounts payable, operating margin, total margin, whatever it may be that the organization decides is the key indicators that they need to track to make sure that they're successful. Those should be put together in a very easily used format, and have a comparison or a trend analysis over a number of months, as well as comparison to previous years. Again, I'll probably mention this a couple more times as I go through this. Trend analysis is one of the easiest ways to identify positives and negatives in an organization's operations, and really should be used as a tool to make decisions on an ongoing basis. Key utilization indicators, things that what's driving the business. Is it number of units served? If it's a hospital, is it average length of stay? Is it patient days? Is it what the inpatient surgery cases are? Is it case mix? It could be any slew of things for a healthcare organization, that the key indicators that are driving the operations. But those should be, again, put into a trend analysis and monitored on a monthly basis, as well as compared to budget, as well as compared to prior years. Again, it's a way for the organization to look at favorable and unfavorable trends that can help make decisions and help make changes in the organization's operations to make sure that you cut back on the unfavorable trends and increase the favorable trends throughout the organization. The next section we'll be talking about is reporting, other reporting for a nonprofit or a healthcare organization. And the first item we'll talk about is the IRS Form 990. And that comes in multiple forms. It's either the IRS Form 990, the Form 990EZ for smaller healthcare entities, the IRS Form 990T, which would be the taxable form if the organization has unrelated business income taxes, and then the 990PF, which is for a private foundation. Each of these forms is filed with the IRS. They're due 4.5 months after the organization's year end, and they're allowed up to 2 90-day extensions. So if you do the math, you can basically file it 10.5 months after year end, which is something that many healthcare organizations do because compensation of key executives, key employees is actually reported in the Form 990, and those executives like to hold on to the 990 as long as possible to not have their compensation disclosed to the general public. If you're in Massachusetts, the Form PC is the Form Public Charity. It's filed with Massachusetts Attorney General, and the deadline is the same as the IRS Form 990. And then also the Massachusetts Annual Report, you file that with the Massachusetts Secretary of the Commonwealth, and the deadline for that is November 1st of every year. Now, just quickly on the 990, I've mentioned it a couple times, but basically it's not a tax return. It's an information return because there's no tax due on the 990 unless you have a 990T for unrelated business income. But typically there's no tax due, and it's really the IRS is creating a database of information about each healthcare organization and in general about the healthcare organizations. So the 990 changed a few years ago, and it's really gotten more intrusive in terms of the organization's activities in furtherance of their exempt purpose, the changes in their activities and governing documents, their governance structure and financial transactions amongst the governing body, as well as compensation of the organization's key executives and key employees. The community benefit of the organization, again going back to that concept of charity care. Policies and procedures within the organization, whether it be if there's a whistleblower policy, compensation review policy, conflict of interest policy, etc., whether or not they have those key policies and procedures in place. This is all information that the IRS is now accumulating and looking at, and it's really incumbent upon healthcare organizations to make sure that they are reporting this information accurately to the IRS in order to help that database be able to be grown and create a database of information on healthcare entities. Other reporting, just quickly, cost reports. Hospitals file cost reports with Medicare, and if you're in Massachusetts, you also have the 403, which is the Medicaid report. Nursing homes, which again are healthcare entities, file with Medicaid. There are adult day health reports that are cost reports. There are home health cost reports, as well as hospice provider reports. And the purpose of these is the support for your reimbursable claims that have been submitted to either Medicare or Medicaid. They provide detailed costs and allocation of costs that are provided to specific service centers. And it provides Medicare and Medicaid information on the types of services that you're providing at your organization. So it's a key function of the organization to submit their cost reports on a yearly basis to whatever extent they need to based on the services that they're providing. And then just to the last type of reporting that we typically see in a healthcare entity would be any governmental reporting under OMB Circular A133, which is that for states, local governments, and nonprofit organizations that expend $500,000 or more of federal awards in a given year. This is also commonly known as a single audit. And if you're in Massachusetts, the Uniform Financial Report, which is applicable for any entities receiving $100,000 or more in state contracts. In addition, the Form 3ABC, which is a tax exemption form, needs to be filed on a yearly basis to ensure you're not paying any property taxes for your exempt organization. That basically takes us to the end of this podcast. It's been a pleasure putting this together for you. Again, my name is Eric Lynch. The things that I've discussed today are an audited set of financial statements for a healthcare financial entity, the monthly financial reporting and the importance of that financial reporting for the governing body and management to be able to make the correct decisions for the organization. We've talked about the federal Form 990 and the Massachusetts Form PC and the importance of those filings, as well as other filings like the cost reports, the OMB A133, and for Massachusetts entities, the Uniform Financial Report. So again, I want to thank you for taking the time to listen to this podcast. If you have any questions, please feel free to contact me, Eric Lynch, at 617-742-7788, or you can visit our website to contact Feeley Driscoll in general at www.fdcpa.com. Thank you.